So tell me something good, man. What's going on in your world? Anything exciting?
Yeah, daughter just graduated from college, which is great. Sons are home, everybody's home, so it's good. Just cranking away, looking at some new deals, which is cool. Really excited. Some data center opportunities and um,
Where are you
just
looking at those? Where are those located?
southern South Jersey and Massachusetts.
Okay.
Yeah, pretty neat stuff. And then we've got a great project that's in construction right now. On Route 50 and 123, right down the road from George Mason, behind the old Amazon Fresh, because I guess all the Amazons are closing. We broke ground on in October, and it's going cool, man. We got to go grab some. There's a great Andy's Pizza over there. We should go and look up.
Cool. Good. What was I gonna hear? Stella's actually in, just to give you some background, San Francisco. They're in San Fran.
Nice.
Yeah. Yeah. Very cool story. We're gonna be launching, I think I told you, an investment club, kind of like a grid debt fund investment club. But what's so cool is that you could set up lots of different investment clubs, right? And you could set them up so that you're also not specifically don't need to do real estate, right? So you could be investing in businesses. You can do a lot of different things. Let me see
Cool.
if I let me see. Let me call her real fast.
Rob, I just sent her over the link too. So I just asked her if she's got it. So
Is that Eric?
yep,
Hey,
yep, that's
hey,
me. Hey, how's it going? How are you?
what's up, man? I'm like, yeah,
Sorry,
let me
I was looking for the link myself, so I'm like, all right, if I had trouble finding it, I'm sure Stella does too. So I just sent it
okay.
over to her. Yeah,
It's all good. It's all good. Yeah, because I think there was on your calendar, my calendar, there was like two different events.
yeah,
Yeah.
yeah.
Yeah, that was just for us. I think my assistant set one up and then Jess set one up. So cool. Eric, are you in San Fran as well?
No, I'm actually an East Coast guy. I'm in New Jersey, so opposite
Okay,
end.
Jersey.
Yeah, yeah. How about you? Where are you based out of, Rob?
DC, DC
Okay,
area. So
nice,
Northern Virginia.
nice.
Yeah. Cool. Well, Jersey's not too far away from us, man.
No, I love DC. I try to get down there every so often. Yeah, DC, Boston, Philly. Like to do the short East Coast trips as well.
Eric, will you be joining us at GridCon?
I don't know that I will be. The dates are, I think I'm traveling. It's early June, right?
Yeah,
Yeah. So I
June
think,
1st and June 2nd.
yeah, I'm going to be overseas, unfortunately. Otherwise, I would be there.
Okay. Where are you going to be?
I'm going to be in Germany at that time visiting my grandparents. My dad's from Germany. So,
Oh,
yeah,
that's cool.
yeah,
That's exciting. That's cool,
yeah,
man.
yeah. Maybe you want to shoot Stella a text too, or I can shoot her a
I did
text,
send her a
Rob.
text. I sent her a text.
Okay.
I'm like, you jumping in? I
Yeah,
was
I
like,
know she's
West
been on
Coast
back to
people.
back. Yeah. We did a webinar this morning as well, so she'll be fully prepped and ready to go.
Okay. How long have you been at Fractional now?
Gosh, it's almost 3 years now. Time's been flying for us. The last couple of years we've built some pretty tremendous partnerships with you guys as well. So
Mhm.
that's kind of been my newfound role here is doing partnerships and affiliate stuff. So I love working with, people like yourself and some other partnerships we built. It's just really fun to get to help people at a level that it's, you're also helping people with your community. And, I think for us, and I'll let Stella speak to it more, but, for us, it's a lot about educating people about what we're doing. This morning, Stella spoke with a group of fund managers and syndicators that are focused on like a fund of funds style investing. And,
Mhm.
for them, it's like, once they heard about this, right, it was like their mind was kind of blown, right? And I think that for us has been a really fun part of the journey is, just educating people on what we do and letting them know it's out there. I'm sure even for you, when you heard about it, you were like, whoa, like this
Well,
is
it
kind of
solved a big
different.
problem for us, right? So I think like all good technology solves a problem. So, we were like, okay, well, we know we want to do this. There's a couple different vehicles to do it. Um, but it's all about removing friction and what you guys did with fractional removes a lot of that friction, right?
Yeah.
So, um, yeah, so I'm excited about it. While we kind of wait for Stella, we're waiting for Stella to come in here. Um, if anybody on here, like anybody that's on here right now, if you would do me a favor, big favor, I love to see everybody's lovely faces for our speaker to create energy, right? So I know that when I'm presenting, I'm like, I want to see who I'm talking to because it's so hard when it's just, you know, a name and everybody's muted. So if you do me a favor, if you have the ability, please turn on your camera. It'd be fantastic. And then why don't we just call Stella real fast? Thank you,
Yeah,
Ryan, for
that would be
turning on your
great.
camera. Did you call her already?
No, but I can give her a call, Rob. Let me give her a call real
Okay,
quick.
cool. That sounds good. Okay, while we wait on Stella, John, talk to me about some of the projects, right? Like what's interesting about this, do you know anything about like investment clubs, just how they work in relation to like what you do, like raising capital the way you do it?
Yeah, I mean, I have a couple of mastermind groups that I work with.
BJ,
Yep.
yeah, if you're totally naked, no, don't do it. Don't do it.
Yeah, I mean, I'm familiar with bringing folks together on the education piece, talking a little bit about how to do it, how to look into it, and then really putting together kind of like an investor club. Everybody kind of has some things they would lead or work with, and we kind of go through a deal together and we kind of identify who the best folks are for certain things. Like I like to I like to focus on the relationships, the emails, the operations, but I'm not, I don't love the numbers. I'm good at them, but I don't love them. So if there's somebody better than I can do that. I'm all about it. But everybody kind of breaks up, kind of has their duties, and we work together to see what we can find because 10, 15, 20 heads are better than one.
Yeah, for sure. For sure. Well, what's cool about this, and Stella will walk us through this when she comes in. This is what's cool about the way the club works is that you don't need to be an accredited investor, right? And it's because people are actively participating in the project. So you
Mhm.
kind of learn while you earn. And I love that idea. People can come in and start learning the game without risking a ton of capital and
Mhm.
participate with a larger group where we're just how like you were talking to me, like we sidecard it, right? And
Mhm.
we all invest together in those projects. So I see my brother from another mother, Mark Beckett, just jumped in here, right?
And
We got
Robert,
Hey, what's
just to let you know, uh, originally I had this as a Google Meet in the calendar. That's why I ended up being late, trying to figure out why I was there by myself, not able to get in. Have you heard from Stella? Do you know if Stella has
yeah,
the
yeah,
correct
I'm
link?
yeah,
here.
yeah,
I'm
yeah.
here.
We
Oh, Stella's here. Cool. All right.
okay.
So it's just me. I'm the only dumb one.
Yeah,
Sorry
what
about that. I
happened
went
was
to the
that
wrong spot.
Kayla booked it for us there, but yeah, you went to the wrong
Yeah.
spot.
Got
Stella,
it.
what's up? The
What's
woman of the
up?
hour.
I'm so excited to be here. Sorry for running a little bit late, but we're gonna make this jam-packed and full of crazy gold nuggets.
That sounds great. Listen, I expect nothing less than people from the West Coast being late for people from the East Coast. You know what I'm saying? No, I'm messing with you. I'm messing with you.
West Coast? Holla.
That's right. Oh, that's right. Nick's on the West Coast. He's in LA, right? He's runs our Grid LA chapter. I don't know if you guys haven't connected yet. You guys definitely need to connect, right? And Stella, were you able to connect with either Gary or with um oh Andrew?
Andrew, yeah, Andrew and I are talking next week, so we're
Okay.
yeah, really pumped for it.
Okay, fantastic. Well, listen, I'm pumped to have you in here because it was almost like perfect timing when you and I got introduced. Mark and I had been talking about setting up an investment club, and there's a lot of different ways and structures that we were thinking about setting it up. And they all were requiring a lot of money to set it up. And we were always worried about the compliance when it came to setting it up. And then literally like magically you dropped in my lap with Fractional. And so I wanted to bring you to the grid community at large to talk about what is Fractional, who are you, share a little bit of your story, your journey with the broader network. This is actually, I'm sure Ria is pushing this out live on Facebook Live right now to our community. So without further ado, Stella, introduce yourself. Who are you? What do you do?
Awesome. Well, I am so pumped to be here. Everyone, I'm Stella. I'm actually going to be in person at GridCon, so hope to see you all there. Be there or be square, right? So excited to finally be in real life with everyone. Based out of the San Francisco Bay Area, been on the road a lot, currently in Dallas right now, actually. Real estate investor myself too. I actually personally own 150 units in my portfolio. Most of it is out in Atlanta, Georgia. And really, how I got started with building Fractional is through a lot of my personal pains. And I honestly do not wish that upon anyone here. So I'll give everyone a little bit of context on just, what happened. So I was buying real estate out in Atlanta, started out with, the basics, single family homes. That was scaling really nicely to me. And, I started looking around and noticed, a lot of folks around me, they were doing bigger deals, portfolio deals, getting into multifamily, and really just reaping the benefits of the economies of scale, right? And and I was like, yes, I want that for myself as well. How do I get to the next level? And I came across this portfolio of 22 duplexes out in, my market in Atlanta. The underwriting was great. I was like, yes, how do I get this deal? I really want this deal. But looked at my Bank of America and did not have $1 million in there, which was what I needed to get the down payment, rehab costs, reserves, all of those things, right?
By the way, she was like 22 at the time, just to give you perspective. Okay, keep going.
So I'm like, okay, well, I need $1 million to get this deal. I don't have $1 million. What do I do next? And, I've heard about this concept of other people money, right? So now I'm like, okay, I need to raise the money. How do I do this? And I asked my mentors, and they're like, well, the way you can do this is go form a syndication or go do a fund, but since you have a specific property, a syndication would probably be the right way to go. So I'm like, okay, that sounds good. Let me just, make sure I actually have enough investors that want to do this with me. So I pull out my phone and, I start literally calling every single person in my contacts. And luckily enough for me, because, I'm always on social media telling people what I'm up to, I ended up having a lot of family and friends who were like, yes, count me in. We've been watching your journey. This looks really fascinating. We want to build our wealth with you. And I did the math, and I always love to say this joke, but being Asian, right? Like I'm very good at doing math here. So I counted up the names and the soft commitments, and I actually had, $1 million in soft commitments from just people in my network that wanted to go in on this with me. So I'm like, great, this is gonna work. This is awesome. And, boy, was I wrong because, the moment I actually started that syndication process, I had to go find a securities attorney. I paid that attorney 30 grand right out of my pocket without a dollar raise. I was already, negative 30K down the drain. Only to find out, with a 506B, I couldn't market my raise and I could only take 35 unaccredited investors, which actually made me had to cut out a lot of the people that said yes to me because they were past that, 35 unaccredited investor mark. And I was like, okay, well, what are my other options? And they said, well, you could also do a 506C where you could market, but that's for accredited investors only, which also doesn't help me because most of my investors are unaccredited, right? So was just feeling super cornered, and I ended up just biting the bullet and doing the 506B. And then it took 4 entire weeks to go get all the filings done and go make this private placement memorandum, which is like a tongue twister every time to say it. And after that was done, I had 2 weeks left before my close of escrow. Guys, like I had no idea what I was doing here. Like I didn't know that I had to negotiate a longer timeline, all those things, but it freaking sucked. Like I had 2 weeks left. I could not raise $1 million. And at the end of it, I lost the deal. My EMD had already gone hard, and the seller's like, well, you don't have the money, so I'm not going to give you the deal anymore. So 30 grand, to the attorney for this, jumble of paperwork for a deal that no longer exists, plus my EMD that's now lost. So I lost 55 grand on that deal. And every time I say this story, like I feel something in my heart where I'm like, man, like I never wish this upon anyone, and I do not ever want to be in that place again. And for a period of time, like I honestly felt like I wasn't meant to go bigger and go after these bigger deals. I thought maybe this is like the world telling me to go, stick in my lane and just do single family homes with my own money. And I'm sure everyone can relate to this, but it is just impossible to take no as an answer when you're an entrepreneur, right? Like I just
Mhm.
could not live with that being the outcome of this. So I'm like, okay, well, what else is there? Like, what else can I do? And growing up in the Bay Area, I actually had a lot of friends who worked with me together, and we created this thing called, an investment club, but primarily for stocks, crypto, and startup investing, where, all of us believe in the same thing. We would pour our money together, and we would, vote on which projects we wanted to deploy our capital on, how our portfolio is doing as a whole. And it just made me really wonder, right? Like, how come when my friends and I were doing that, like no one ever said anything to me about getting a securities attorney? I didn't have to deal with the red tape. What is the fundamental difference, right? And then it really came down to, I'm going to start sharing some slides here.
Yeah, you do it.
Yeah, it really came down to the investment club having that active participation because, we were voting and we were doing things together. An investment club is actually not considered a security by the SEC, which was why, we didn't have to go make a PPM. There was no, having to pick between the lesser of two evils with the B or the C, right? And no securities attorney, no weeks of paperwork. And it made me realize like nobody in real estate knows about investment clubs, but we want to operate in that fashion, right? Like similar to how we're all here together, with grid and as a community, right? It's like we believe in the value of smart people who want to do the same things, putting our heads together, making collective decisions together so that, we're more successful, right? As a collective rather than me with my own cash making my own decisions. Like that
Mhm.
doesn't take me down the farther path. And that really gave me that light bulb moment where I was like, man, like if only investment clubs were well known in real estate. Well, I've lived the horror story of doing a syndication and raising money in real estate. Also run investment clubs for not real estate. Let me go blend these together. And that was really what gave me that inspiration of creating Fractional as a company, where we're now supporting operators in creating investment clubs where you can now legally raise capital from anyone in your network, including unaccredited investors, without needing to set up a fund or a syndication. So did that, and we got some initial traction. I don't know if folks here are familiar with Y Combinator. It's a very famous accelerator that has given birth to companies like Stripe and Airbnb and DoorDash. So we got into that, and one day I got a call from Zachary Fallon, who is the senior counsel of the SEC, and he leaves me a voicemail, and he's like, "This is Zach. I'm from the SEC. Please give me a call back." And it is like not the call you ever want to have, right? It's like when you get a call from the IRS, it's never a good thing. So I'm like scared shitless. I'm like, why is this guy calling me? Like, I'm pretty sure I'm doing everything right, but like clearly something is wrong. Am I going to jail? Like, what's happening here? So, I'm like really, really nervous and I call him back. And that was honestly the most magical conversation ever because he tells me that, he sees what we're doing. He's been following, companies coming out of Y Combinator, and he really is so bullish on this idea and he feels like it's a game changer. And he ends up joining Fractional as our legal counsel to make sure that, we're doing everything right as a company and we're making sure anyone that's running an investment club on Fractional is fully compliant. And that was honestly like the most pivotal moment of my life and the company's life. And I reflect on this every day, and it really just comes back to like if you are going through some hardship and you have a really strong feeling about something, and it could be really contrarian, right? Like I think what we're doing with investment clubs is certainly contrarian to your traditional syndication, but if you're willing to bet it all, the right stuff will happen, and that is exactly what happened to us here. So I know like all of us here can really connect to that, and that has been just a really strong, fortifying part of my belief as an entrepreneur is to lean in harder because really great things will happen out of that. So that's the backstory of how we came up with Fractional and how we got here. So now I'm going to get into tacticals. And Rob, feel free to interrupt me at any time.
Yeah, for sure.
Yeah,
For sure. What I love about this is when did you get into Y Combinator? Like how many years ago was that?
that was back in January of 2021.
So COVID time, right?
Yep, COVID
Yep.
time. Yep.
Hardcore. And so, oh my God, like what I love about the story for anybody that's been paying attention in here, it's she took this lemon that was handed to her and she started making lemonade with it, right? And came up with a better idea, which is fractional. And like I said, it solves a lot of problems for us. So why don't we get into the tactics, Stella, of how it works? Because there's somebody in here right now saying, I know when I started speaking to my friend John, by the way, we're going to open it up questions later. John was like, how is she doing this? How is this working? Right. So I'm sure John's gonna to jump in and ask some questions later on because he raises a lot of capital here. So
Love it. Love it. Awesome. Well, I'm going to go into some case studies to really break this concept down, right? I would love to get a read of the room. How many of you here are doing fix and flips? Is that a common strategy in the group? If that is, like
yes,
drop a one in the chat. All right.
one,
Okay, we
one,
got fix
one.
and flippers. All right. Well, this case study that I'm about to give is related to fix and flips. And we're going to look at this from two perspectives. The first one is, if you're raising money for your own flips, right? So, especially when you're getting to a point where, you're now doing multiple flips a week or a lot of flips a month, right? Sure, you can raise money from individual private money lenders. That's cool until it's not cool because, even with, our mutual friend Brandon Brinham, right, Rob, like you get to a point where you have so many individual private money lenders. Everyone's got their own schedule, everyone has their own different terms. And then now all of a sudden, you're not running a flip business anymore. You're running like an admin business, trying to service these loans and figuring out, when you're supposed to pay Bob versus Sally and Joe. And that becomes so crazy chaotic. And then people start thinking, okay, well, how do I, basically do almost like a debt fund, right? Where you want to raise all the capital all in one go. So that's really what Pace is doing here, where, instead of doing a fund, because now we all know the terrors of running a fund, right? He's like, well, let me create a debt club for my flips. So it starts out with a club, and every club has a criteria to begin with. So in this case, right, because it's lending to fix and flips, he goes, hey, who wants to lend to me where I'm doing fix and flips? Y'all are gonna be in, first or second position, securitized with, a deed of trust, and we're gonna do 12%, right? That's what I'm gonna offer you. And then I'm gonna open this up to anyone with 20 grand. You can set your minimum investment, but Pace goes, I want to open this up to anyone with 20 grand. And then he'll host a series of Zoom calls and just bring anyone who's really interested in this overall criteria to listen in on his track record, what he's done in the past. And they're like, yes, Pace, we would love to lend to you for your flips. 12% sounds great. Let's join the club. So now all the money is being pulled together. Pace raises $2.5 million. And what Pace does next, and why this club is different from a fund, is that Pace, as the leader, he's then going to bring back deals that fit this criteria back to the club members. And they're going to vote to approve that, this in fact is a flip and it is at 12%. It's in, first position. We're good to deploy, let's say, 300K out of the 2.5 million on deal one, and then another 200K on deal two, etc., right? All the way up until the funds are deployed. And
Mm.
then Pace usually will have the club be set for 2 to 3 years, which again is a huge win compared to if you were just raising from individual private money lenders, because with that, you're usually returning the money in 6 to 12 months, right? Now, when you have the next project, you got to re-raise the money, and that's not scalable. Versus here, it's like he's raised $2.5 million in one go, pretty much. And then he gets to work that $2.5 million and cycle through many projects for 2 to 3 years, right? Like, see that level of difference in scalability, right? So that's really where, if you're doing fix and flipping and you're at that level, right? Like, go do a debt club instead of trying to, raise individual funds from individual private money lenders all in different timelines. So
Stella,
that,
that's
yeah,
what that's going to be our first club, right?
yeah,
That's what we're going to do. We already have a project assigned to it. Um, and it will be for first and seconds, right? Because we also do this concept of renovate now, pay at settlement. So it'll be a combination of those two. Um, and I was thinking 2 years, but you're saying possibly as long as 3 years, right?
yeah,
Can you do
yep.
2 years with an option, or is there a way if people wanted to pull out their money sooner? Like, is there like I wouldn't want that, but I'm just wondering if Pace does anything like that.
Yeah, that's a great question. So definitely it's important to drive alignment on how long the club is going to run for in the beginning, right? Like you wouldn't want someone who only wants to be around for a year to be in a club that's 3 years, right? Like that's just misalignment. But we certainly understand that sometimes things happen. So in that case, right, like if you're, let's say you have a family emergency, you would like to exit the club for whatever reason, what you could do is ask an existing club member if they'd like to buy your position. So that's an option. Or you can find someone else right in the community that wants to take your spot. They can take your position as well. And Fractional, we would be able to handle that transfer of ownership.
It's interesting. I don't know. Is that put into the operating agreement typically, Stella? Because we have done that internally within our team. And if somebody wanted to get out sooner, they'd have to order two appraisals. We take the average of the two, and then we discount that by, I think it was like 15% because there's just an operating cost that's there. Have you
Yeah.
seen other people do that?
Yeah, so they can decide, whatever is the price of their ownership,
Got it.
right, in the club. So kind of just let the markets or the internal members of the club to decide that. But certainly I love your framework. It, puts more structure in that decision making as well.
Okay, cool. Sorry to derail us. Go.
No, that was great questions. And then just building on top of this debt model, right? So we just talked about making a debt club to lend to your own deals. Well, building on top of that, you could also build a debt club and almost run like your own hard money lending business, essentially, right? Like you could lend to other people's deals. Like you might have a network of, other flippers, right? And you could lend to them directly. And something that's really interesting here is you can actually essentially like create a profit sharing agreement where both your investors and yourself is winning through this hard money lending business that you're running. I'll give an example. So Pace, he might be, lending to a fix and flipper actually at, 18 or 20% even in second position. Well, he'll bring that back to the hard money lending club and say, hey, you all will still get 12%, which is why you came here. Is it cool if I take, 8% because I brought the deal and I'm, creating deal flow? And the club members are like, heck yeah, right? Like, of course, you're bringing so much value to the club. We would love to put a profit sharing agreement in place. Maybe you're charging some points, right? Like you could take the 1 or 2 points you're charging as your side of it for creating value for your club, and then, your investors still make their 12%. So that's like another layer to it where you could essentially like run your own hard money lending club with different investors as well.
Hey, Stellar, can I jump in? This is John. I
Yeah,
love
go
your
for it,
energy.
John.
You're awesome. I got those calls from the SEC too. I had to get definitely different changes of underwear a number of times, but it's pretty cool because like when they call you, they like what you're doing, and we've actually had SEC attorneys that want to invest with us, which is really cool. But yeah, I feel you. That's a scary call. But yeah, going through that process, it's we do that. We do a fund of funds. We do SPVs, single purpose vehicles. What's interesting about these groups you're talking about is how do you still fall inside of compliance so that the SEC is like, hey, you're technically raising funds. So do you, like Rob said, have an operating agreement? have everything lined out so that folks that are investing inside the operating agreement are all in a closed network. We're in a group. We all know what we're doing, and everybody knows the risk, and we're all members inside this operating agreement. So we're not bringing outside people, which then would potentially raise the solicitation challenges. So I guess my question is, how do you structure it from a compliance standpoint without getting into any kind of, bad looks from the SEC?
Yeah, for sure. Great questions, John. So one, just digging a little bit deeper into the fundamental difference between a club versus a traditional syndication or fund or even fund of funds, right? Is that there is that level of active participation that is being met when the club members are voting and approving how the capital that's already been raised gets deployed. And then if there's any major deviations of the business plan, they would be participating and approving on those actions as well. Which is why, fundamentally, the SEC does not view investment clubs as securities. I'm going to pull up the SEC website really quickly here. And Eric, feel free to drop the link in the group chat. This is, the SEC describing what a club is and why they don't regulate it because they don't view it as a security. So that is all in place on the Fractional platform. I'm actually going to share Brandon Brittenham's Mailbox Money Club really quickly for everyone to really like visualize this. So Brandon is doing Debt Club as well. So literally that case study that we just went through, very, very similar. So it's formed around the criteria, right? So people are like, yes, we're coming here over this specific criteria. And then they actually vote on the Fractional platform that they agree that this is the business plan. This is how we're going to make decisions together. We're going to actively participate, right? So all of this voting, and Rob is actually in this club. So he's experienced what this club is like from an end investor's perspective. All this voting and active participation, it is all tracked and logged on the platform so that, if whenever SEC is like, hey, can you prove to me that these people participated in key decisions? We're like, yes, here you go. These are all the things that people participated in. So that's all on the platform. And then exactly to your point and Rob's point about the operating agreement, we actually handle all of that on Fractional's end. So we create the LLC, that's the entity that all the investors become members of. They sign off on the operating agreement, which has the rules around like, how do they vote and what do they vote on and all those things. All the money movement, that's all handled directly through the club page, the voting, as I mentioned, and then everything back office is done through the platform as well, right? Like no one ever wants to sign up to be a full-time CPA or admin, right? Like that is not fun. I certainly don't want to do it. So Fractional, we actually handle all of that in-house as well. We do all of the profit distributions, automated. We handle doing the tax filings and we create K1s for every single investor. So really, legal, compliance, back office, participation, that's all done, one-stop shop on the platform, and it keeps this a compliant and safe place.
So what you're doing is unbelievable. I have to give you a huge compliment because, yeah, when it takes 4 to 6 weeks to do a PPM, and that's even on a deal that, the attorney's taken off the top shelf, and it costs 25 to 35, $40,000 for the PPM, for the blue sky filings, for the attorney's time. So, yeah, this is brilliant, and I think yeah, people should listen. This is great.
Let's go.
I brought John in to sniff it out, Stella.
Love it. Love it. I'm passing the sniff test. I love it.
Yeah, I love it.
Great questions. Awesome. Okay, well, I'm going to keep going because we just talked about debt as an example. But that certainly doesn't, have to be the only type of strategy, right? Multifamily, similar to what I was doing. This is Matt Starr. He's now become a very good friend of mine. Very similar logic, right? Like you still start off with a criteria. So Matt is like, hey, I want to go do multifamily on the smaller end, and he's doing, value add. He wants to be, in a high demand, supply constrained submarket, doing, 24-month stabilization, now holding for 7 years, right? So this is an even longer of a timeline, and they want to target, 20% plus annualized returns, right? So create your own buy box, right? That's the criteria of the club. And then he wants to make this super accessible, targeting, a smaller raise amount potentially, right? So he goes, hey, I'm going to open this up to anyone as long as they have 10 grand or more. So you can decide that. And then again, the same thing, right? Matt then brings back a multifamily deal that fits. The investors are like, great, this does meet our buy box. Let's go, deploy that capital towards that specific deal. So exactly, similar logic. You could do that for hotels as well, right? Brittany Arneson, Sujay, they're really into hotels. Same exact kind of steps. Define the criteria, bring the investors who like that criteria in. That's how the funds are pooled. Then they, sign off on whatever deal makes sense. And then here, I want to especially call this out. In equity deals, you can get paid for bringing value to the table as well, right? So something that's really common is having a sweat equity position. You're bringing in the deal flow, you're, putting a property management team in place. You a lot of times are maybe the one that's getting the mortgage, right? Like you're being a personal guarantor on getting the loan, and that's you taking on more risk compared to your other investors. All those things are very, very valid reasons why you should be getting paid, right? So Brent and Sujay, they structured a 30% sweat equity position into the deal, and the investors were totally, fine, and felt that they should definitely reward Brent and Sujay for their work on putting this together. So you can get creative even on the equity side, right? And how you get compensated through deal structure as well. And then this is really just diving a little bit deeper into the flow of funds and process-wise how things work. And one thing that I find really fascinating about the club, and I think this is a huge value, is a lot of times John might have experienced this as well, right? It's you're usually in a syndication, you're building your PPM and your securities documents for a very specific deal. But the caveat and the bad part about it, which is why I failed miserably in my deal too, is that when that deal doesn't pan out, basically all your paperwork that is down the drain, right? Because you made it for a specific property that is now no longer in play. So the same thing actually happened to Brett and Sujay, where they actually did their 506C docs for a very specific hotel opportunity, only to find out during due diligence that that deal is a no-go. So, they had to return their investors' capital, and like the docs no longer made sense. And then a few weeks later, they found another hotel deal, and they came to us and they were like, man, we're really torn, because what if we, create PPMs and, 506 docs again for the second deal, but then in due diligence, it also doesn't pan out. Like, how many times are we gonna, trip up over this, right? So I asked them, I'm like, well, how different is each deal that you're looking at? Like, do you have a pretty defined buy box that's not really changing? And they were like, yeah, like we do. And that's what our investors are here for. Like, they don't really care if it's 123 Main Street or 456 Main Street. Like, they just care about the overall criteria. So I'm like, great. Well, that's exactly why the club is better, because you could have a potential deal. That's fine. But the club is not married to that deal, right? Your investors are just married to the club. They're pulling money for this criteria. And you can then deploy funds to deal A or another deal B or another deal C, right? Like, it doesn't matter. You don't have to redo the club. You don't have to redo the docs. Everything is really just set up around that buy box, which gives you a whole new level of scale and not having to just, repeat your mistakes over and over again. So that's why, the club model was really great. And, you pretty much just think about the club as one single really big investor, right? So 70-30 split, you can have a pref as well. And then everything that, I was just sharing with John, right? Like, we're handling pretty much abstracting away the distributions, the individual K1s, the tax filings, all that, we're taking care of on Fractional's end.
You're talking my language. I love this stuff. So, great point that you're bringing up here with a club. And when you bring in more money, you can actually dictate better terms with sponsors sometimes. Like, so if a sponsor's raising $5 million and you bring in that full $5 million, you could start negotiating better terms for your group. So that's another powerful part of this, is that as that more of that capital comes in, it gives you a little more flexibility. I love the fact that you mentioned that you could be a GP on a deal, and you could actually lead the deal, and then the investors could be LPs and or co-GPs, which is awesome. And maybe you'll talk a little bit about that. But then going out and doing syndication deals as well. So yeah, this is great, and this is a great chart.
Yeah, yeah. And John, I know you've done like I think you've done funds of funds as well, right?
Yeah, we typically do SPVs, one or
Okay,
two deals
SPVs.
max. Yeah, 5 or 6B because we have a closed network of our investors, 200 investors. But when we do Cs, and we're syndication, we have one deal we're doing. We're a GP down in Hilton Head. We're building 2 new construction homes. What's nice about doing it as a GP is you get to call the shots and bring in the money. And if there's no debt, you run the show. So Rob, with like a fix and flip where you can bring in all the cash, it's awesome. You're the bank, you're the equity, you call the shots, you get the terms, and you basically then have the flipper, the contractors as part of potentially the team, or just contract them out to do their work, which
Mhm.
is cool. But yeah, we usually do fund of funds, and it starts and ends with that specific deal. And it's cleaner, like you said, right? Because I mean, if you're doing 20, 30 deals inside of one ppm, that's a headache in itself from a tax perspective with all the K1s you're getting. So it's
Yeah,
easier.
exactly. Awesome. Love the caliber of this room. This is amazing. And I mean, there's so much variety with what you can do with clubs. Like I gave a few examples. And one of my favorite ones that I've seen come through the platform is this woman, Tracy. She's really into candy. Like she follows, Warren Buffett's whole like seize candy model. So she went and built like a candy store club where they're buying a bunch of candies stores and then they're, wanting to eventually roll that up and exit to PE, right? So it's like you could do businesses, you could do, single family homes, co-living, right? Like whatever it is, that's your passion and your specialty. You can create a club around that and bring like-minded investors who believe in that same criteria and how to operate, bring them into the club and really just create a really, really collaborative experience. And that's how you build better investor relations too, is, really connecting with your investors where they understand, right? Like what are the meaningful things that are a part of making a good investment decision, a good operational decision. And, that's how maybe start out with a 25K check investor and eventually, they're investing 250K with you, right? So I really love the club model as a way for you as a capital raiser to start without the red tape, but also too, helping your investors, right? Building your investor network where you can capture them day one, instead of, right, like when you're running a 506C, everyone's fighting for, this many accredited investors. Like it is freaking competitive out there. Why not, bring in the people, right, in your sphere, bring them into your investor network early and then nurture them to become your whale investors later on. Like I see a lot of magic in that.
Yeah, I think something that stuck in my head, Stella, that you said that really resonated with me that I think you picked from Pace was it gives people the ability to learn and earn, right? People can come in here and start getting comfortable with the language and the math and the terms, right, associated with it. And it's a way to build trust if you're executing the play properly.
Rob, you just read my mind because that was my next question is how do you start where you could provide an education piece and it still fall within the precedent of the club inside of the fact that, hey, people are joining, we're going to do the education portion first, right, as one part, and then eventually we're going to graduate into the investment side. Is that something you can do through this? And would it be considered, I don't want to say the word legit, that doesn't sound right. Is it considered valid to fall under the pretense of what the law say?
Yeah, we actually have a lot of community owners and educators run investment clubs exactly to what Rob was saying. Like just the club itself, right? Like that is already educational because it's not like, people are giving a check to a black box fund and they have no idea what's going on, right? Like they get to be almost like a board of directors, right? Where they get to understand the more material decisions that goes on in a business without having to dictate, what color you're painting a wall, right? Like we're not trying to involve people in that amount of nitty-gritty, but understanding more holistically, like how does an investment work? Like what are the fundamentals of it, right? Like that in itself is really, really educational. And then, we've seen people do some really, really fun things where, maybe like to incentivize people to jump into the club earlier or to, participate with a larger check size. You could offer like, one-on-one coaching calls, for example, or do like a live property tour together with people that joined within like the first week of you launching the club. I've seen folks make swag as well, which is really fun. I'm part of one of the clubs. They named their club the Amigos Club. So whenever like we're all going to a conference together, we show up in like our Amigos t-shirts and like wear mustaches, and it's so much fun. So yeah, like lots of really great ways where you can give value, and even have that almost be like a perk, right, for people that are joining your club and have that really be tied to the education component.
That's how we saw it with Grid, right? Like, obviously, I think the club is just a level deeper connection with club members, right? There's the overall Grid community, and then like, okay, those that actually want to get into the club are going to get more of their hands, dirty and just participate at a different level, right? It's just more intimate level.
And the way I
Well,
look
to
at it
your
is
point,
I think
Rob,
that's what
yeah, Mark.
I think that's what the SEC intends here. If you think about this like the old-fashioned stock investing club, you're going to go research that company. You're going to go research that company, and then we're going to come back and we're going to talk about it. And we're all going to learn what the cash on cash return on this company is and what EBITDA means. And it is meant to be educational. And that's why I think the SEC is okay if us, little guys kind of get together, learn with one another, and then pool funds to do things. That I believe is not only allowed, I think it's part of the point and why they're okay with it.
Yep.
I'm
A
not an SEC
thousand
attorney, but Stella's got one, and I'm pretty sure that's what they say.
1,000% part of the point, which is why I'm such a lover of community. Like, we go stronger together, right? Like, the whole point is I don't know it all and I don't want to, but I would love to lean on other people so we can make smart decisions together.
And Stella, if I can kind of follow up on that participation and education component, obviously a big part of how this works and the way the structure is, again, kind of cool with the SEC is that member participation, and a big part of that is the voting. Are you able to talk a little bit about how the voting would work in a typical club?
Yeah, absolutely. So voting is certainly a big part of it, and it is core to the experience, right? Like even here, people are participating on voting when they're even joining the club, and obviously there's more decisions after they've joined the club as well. At the same time, the club is a business, right? And, people are also living their life. Maybe some folks are off, to vacation in Hawaii, whatever it is, right? So, what we've designed with our council is we want to make sure the club as a whole is active. But if people are just, gone for a day or whatever, right? Like it's not going to hold up the club from making a business decision as a collective. So we have this concept of a quorum, which means that as long as 50% of ownership votes, that is a valid vote that represents the club. And then you would want majority out of the votes voted, so 60% plus, to approve for something to go forward. So that is, essentially our world of finding the happy medium where, people can participate, but at the same time, if you're, off on the beaches, right, you're not going to hold up the club from moving forward on this really amazing deal where we need to make a decision like today on it. Does that make sense, Mark?
That makes a lot of sense. And then just to make sure everybody kind of understands what their responsibility is as someone who runs a club, is you are responsible if you're trying to get your deal done to at least get that quorum of 50%, right? In order for us to even be able to vote, at least 50% of the members
Yeah.
need to
So you
show
got
up.
10 people in the club, 5 people have to
You got
vote,
to drag them there. That's
60%.
right. You grab them by the hair and you drag them to that vote. And then you want to clear that 60% hurdle of approval that commits everyone. So everyone gets told before you put your money in, it's 60. So if 60% or more vote for it, your money is getting committed. So be comfortable with that, making sure everybody understands that. And then your job as the sponsor or runner of the club or whatever you're going to call yourself is to get that 50 and then of course get the 60 because that is how we are also all kind of protected, right? Everyone knows
Stella,
going in what the rules are. We did get a majority of the people voting for it. We're all in on this,
you
right?
could tell he's my chief risk officer.
100%.
I can definitely tell. But exactly, Mark, you're exactly right. And I'll add here, we've had $400 million go through the platform in the last 5 years. No one has ever voted against their leader when they are bringing a deal that fits the criteria, right? So even though there is this participation, you don't want to think about it as like a hindrance where like, oh my gosh, what if people vote against me, etc., right? Like if you're a good operator and knowing everyone here is, people are incentivized to be reasonable and want to move forward because that's the only way their money is going to be working for them is if it's actually being deployed on a deal, right? Like no one's going to be sitting in their chairs saying no unreasonably because then they won't make any money, right? So that's really like a mindset thing to think about too is given that you're a good operator, you're obviously going to find deals that fit the criteria. People that are in your club, they want their money to be deployed so that it's earning money. Therefore, everyone is aligned in the sense of wanting to make a decision quickly. I think Rob, in this club that we're both in together, like everyone, we hit that quorum within 48 hours essentially, and we were able to deploy funds really quickly.
And I think BJ's got a question we'll read in a second here, but while I'm reading it, can I ask you, are you able to be selective about who you admit to the club? To your point about, yeah, I want to make sure that it's people who are aligned with what we want to do. Are you able to say if someone said, "Hey, I heard you had a club, I want to join it," are you able to say, "Well, no, I'm sorry, I don't like your investment philosophy. You can't join my club."
Absolutely. It's your club. So you got to make the call on who's in there, what the business plan is, and yeah, keep it a happy, productive club.
Cool. All right. So BJ's question was about that buy box and kind of how you define what the club is going to do. And so to remain safe with securities regulators, he's asking how tight or loose can that criteria be in your buy box? Can you just say, can you have a club that says, hey, we're going to buy real estate? Or does it really need to be more defined than that? How defined does it need to be?
Yeah, that's a great question. So the how tight your criteria is honestly not a securities issue. It's more of an alignment issue, right? So I'll give an example. So if you just say, we're here to buy real estate. What might happen is you might have some people in the club that only want single family, some other people who only want multifamily, some people who are here for 1 year, and then some people who are in here for five, right? So when that's the case, then you are gonna probably have issues when the voting comes around, right? Because everyone wants different things. It's gonna be harder to hit that, majority, right? And then like you're just never gonna make a decision. So it's really more on that rather than like a securities regulation thing. So yeah, we always encourage people, be as specific as you can. That way, right? Like it's going to be easier to find a deal that people are like, yes, obviously this fits the criteria, no questions asked, like let's move forward with this.
So you can be loose, but you really shouldn't. You should have a tightly defined or as tight as you know you can get aligned investors in your club to define your buy box.
It's
I think
also
that's a great way to think
easier.
about it.
It's also easier to get investors when their mind is focused on the thing that they're interested in, right? Goes back to zoning a market, right? There's some people that only want to focus on multifamily and other people that just want to do, small hotels or they're cool with a debt club, right? They want to be a lender.
I'm going to do one just for Seinfeld fans, Rob. It's going to be called the Human Fund, money for people.
Yeah, it's a great episode, but depending on the ages here, they may not get it.
I know, and we're not doing it anyway.
Stella wasn't even born, I don't think.
Look up the Human Fund, money for people.
Yeah.
All right, sorry, Stella. I know we probably took you off track.
All
Uh,
good, all good. Great questions. And just building off of that, we have a lot of operators that also work on different things, right? Like Pace is an example. He does the lending. He's also really into RV parks. He does car washes too, right? So you can run multiple clubs with different criterias too. That's certainly an option. But also to Rob's point, you probably don't want to run all of them at the same time either. We all know the poison of analysis paralysis, right? Like you don't want to give that poison to your investors where they're now thinking like, oh my gosh, should I do the RV park one or should I do the debt one or should I do to the car wash one, right? Like now they're never going to make a decision. So yes, you can run multiple clubs. They can be focused on different things, but in terms of running the actual capital raising process, it's good to just focus on one thing and have that one core criteria that people are making a yes or no decision on.
Jeff asked a great question, and the answer is yes, Jeff. Can an investor use retirement funds since there's an active participation associated with the club, right? So can this be your self-directed IRA for that?
Absolutely. So you can 100% use your self-directed IRA. If you're raising capital, that's a one-liner that you should include in every single one of your pitches is like, do you have a self-directed IRA or do you have, a 401k that's not working for you? Well, guess what? I can help you put that into a self-directed IRA and you can join my club. So yes, you can. The reason why is, so with a self-directed IRA, they're asking for arm's length. And in this case, you're still arm's length away, right? Like you're not living in this property that the investment club is running, right? So that, length is still there. So yes, you can use a self-directed IRA.
Is it all right to ask about the other, I already know about it, limitation on investment clubs as far as number of participants to make sure people know that?
Yes. Let me get into that right now. Let me screen share again. So I always tell people this, like, even though I had a really bad experience running a syndication, there is definitely a time and place, where syndications or funds are actually the right way to go, right? Like I'm never here to shit on one particular model or the other. And that's why I think it's really important to understand which model is going to give you the most amount of leverage depending on that specific situation, right? So when I look at when is an investment club better versus when is your traditional securities, syndication or fund better. The first one is what Mark was talking about. The dollar amount is really tied to this legal restriction where the SEC only allows for 99 people maximum per investment club. So I'm doing some napkin math here. Generally, with a club, a lot of times you are trying to bring in all types of capital, right? Including unaccredited. So when that's the case, from what we see, generally the minimum check size that people are setting on the higher end for a club is 50K, right? Because you're trying to also involve unaccredited investors. So then napkin math, 50K, 99 investors, roughly that $5 million mark is what I see kind of on the higher end. So usually raising $5 million or under, I think, investment club is great, right? But if you're raising more than that, you're wanting institutional money. A lot of times institutional money, they also want to be completely passive, right? Like all of those things are pretty much securities. Okay, let's go make a syndication or fund, right? Like you do not ever want to try to package a security as a club because then you're going to jail, right? So don't do that. And then related to, whether or not something is a security, another good way to measure that is from deal structuring. So with a club, if the club itself is not investing into a security, then you want the structure to be simple. So on an equity deal, a simple equity split, right? Like the 70-30 that I mentioned, or, 80-20, whatever it is, plus a simple pref. I have a 5% pref, I'm doing a 10% pref. Like that's all cool. That's great. But what you cannot do is have really complex waterfalls where, sometimes syndicators do like, oh, if we hit this other financial metric, I get this other cut. That is a security. You can't do things like, let me have, A, B, C classes. That again is a security, right? So that is another major distinction where simple structure, yes, that's cool. That's not going to be a security. Everyone's participating. That's all great. But the moment, where you're having these really complex structures, probably going that traditional route is going to be a better fit.
We see that a lot. I mean, on syndication, you'll get things like catch-ups and clawbacks and hurdles and stuff. That's when you're starting to get into the syndication route. Yeah, I think that, and one other thing I would say too is like level of risk, because like, a 506C deal for accredited investors only is typically going to be that type of investment because of the level of risk. And so, obviously the clubs need to understand, you need to disclose all of those risks, I think, because that would probably be something that, could get you in trouble.
Yeah. Exactly. But yeah, that's pretty much what I got slide wise. It's definitely been, a really amazing journey. We've helped, people raise over $400 million through this model now. A lot of, mutual friends of Rob and mine. And I know Rob and is starting his own club too. I'm gonna just give a little, sneak trailer about it. There's some like
I was working on the pitch deck today, Stella.
yeah, that's right.
Yeah.
That's right. So big news coming out soon. And yeah, it's been a really wild ride. We've raised money for the business itself as well. So if there's anyone here that's, starting out, I'm always happy to chat about that side of the world too. Just, entrepreneur to entrepreneur. We raised $20 million to grow Fractional as a business from Fifth Wall. They're the largest VC in real estate, Y Combinator. And it's always fun talking about how we've got Will Smith and Kevin Durant on our cap table. This was Will Smith pre-slap, so when Will Smith was still cool.
Yeah, full disclosure. Yeah.
Full
That's
disclosure, yep, that's
yeah.
right. So yeah, it's been really really wonderful, and excited to connect with everyone. My personal cell phone is on here as well. My Instagram handle is Hella Stella to keep it California for everyone. And yeah, like I think everyone goes through hardship, but we're meant to go through that for a reason. And as Rob said, right, like I made that essentially the jumping stone to building something even greater. And it's always, everything is a work in progress. And I love leaning in right on just all the unpredictability of life, because that's what makes things fun and makes us better human beings than we were yesterday. So yeah, it's just super, super grateful to be here, and y'all had really awesome questions and happy to take more.
Yeah, Stella, thank you. Your podcast, we're going to be getting your podcast out probably in the next week or so. If you want to learn more about her story and the journey, I went a lot deeper. If you haven't signed up for GridCon, it is June 1st, June 2nd, so make sure you do that. Pretty much all of our VIP tickets are almost gone, so there's just a few left. That is at the winery of Bull Run or Bull Run Winery. Day one is going to be at Vallow Park in Tyson's Corner. Super sexy, modern location. So excited to have Stella there, right on stage presenting along with a lot of our other friends. And yeah, any final questions for Stella before we let her go back to her California life? Actually, she's in Dallas right now, right?
Yeah, my Texas cowgirl vibe.
Yeah. Who's got questions? Anybody?
I see BJ asked one about the costs, which is a great question. So for everything back office, tax filings, K-1s, profit distributions, that is 3,500 annually per club. Doesn't matter if your club does 2 deals or 10, doesn't matter if you got 5 people in there or 99, it's always the flat 3,500. Year one is upfront as a setup deposit, just so we're sure that you're serious about wanting to run the club. And that is the only cost to you as the club leader. I honestly think it's dirt cheap compared to, hiring a CPA and building your own internal audit team. So I'm pretty proud to say that number. So that's the 3,500 only cost to you. And then for the investors, when they join the club, they pay a one-time 3% transaction fee based off of whatever amount they're investing. And that covers, us setting up the LLC, the operating agreement, payment processing, identity verification. That's another really big part. We want to make sure, no one's a scammer, everyone's a legit human being, right? For being in the club together. So that's what the investors are paying for. It's one time. It's a very standard transaction fee. And the way that, people think about it is, especially if the clubs are, let's say, 2, 3, 5 years even, right? Like 3% one time is what, 0.6% annualized 5 years. Like that is nothing, right? Compared to being able to build double-digit returns, equity, depreciation, whatever it is, right? So that's why for the end investors, they're very happy to pay for that. The math they're doing is they get the opportunity to build wealth with someone that they love and trust and grow together. So yeah, that's our business model. It's super simple, and we are here to support everyone to win together.
Stella, do you ever see club owners reimburse that 3% transaction fee or bake it in or do something like that?
Not really. It's not common just because I feel like a lot of investors honestly expect that. Like they're
Yeah.
not being like is expensive or anything. So it's pretty rare. You could have potentially a club leader, offer to maybe just like include that as something that they're willing to pay interest on, but honestly, not that common.
Yeah.
And if someone did that, I mean, I think that's like really
I think
crazy on their end, but
the
up
easier
to
way
the
to do it,
upside.
Rob, I think the easier way to do it is just bake it into your deal. Bake it into whatever your offer to the investors is. We know you are
Exactly.
paying this to participate. This is still an incredible deal for you, minus the cost of getting in and having all that work done for you by fractional for the 3%. So it's still got to make sense. So,
Yeah, and
but to your point, if you got a
sorry, Mark.
3% deal, all right, that's maybe not so great. If you got to pay 3% to get into a deal that only makes 3%, don't do that deal, right? Don't bring that to your club.
Mark, it's a good point. You can get paid, but you just got to keep it clean, right? Because we're not brokers, so you can't take money off of an investor's plate. But you could obviously charge a fee that's independent, and you have to list out why you're getting paid, right? Like I'm getting the deal, I'm doing the due diligence, I'm making sure like these people are legit, and so there's no problem with that. So I think that's available, and yes, to disclose it as well is so important. But yeah,
I
Mhm.
think that's a different thing. So,
It is. I think he's talking about how you can get paid for basically sponsoring, starting, running the club. And I really liked Stella's example of the equity participation. I don't need anyone to necessarily just pay me a fee for having created the club, but we will have an equity piece that represents the sweat, the real sweat that we will have in finding, managing, in the case of the flips, renovating, and then reporting back to the club on things.
Yeah.
well, if it's a debt club, you don't need to do that.
If it's a debt club, you don't even need to do that. You're right.
Yeah.
You
Yeah.
can do whatever approved thing you do with the money that you raised.
Yeah.
Yep.
Yep. That's
and
the
as
beauty
long
of
as
it.
everybody
It's really
agrees to
highly
it,
flexible.
yeah, as long as everybody agrees to it, it's just it's something you're getting compensated for the
Right.
work you're doing.
For sure.
Exactly.
Everybody, Sally, you're in a room full of people thinking, how am I going to make money with this? But that's cool.
Hey,
That's why
that's an
we're
important
here.
part.
That's why we're here. We're trying to figure out how we're going to make money with this. But yeah, you should be very proud for what you charge for it because it's an incredibly valuable service that people get, and that smaller investors can both learn and earn and become bigger and better investors. That's what we're going to do with it. And so we're really looking forward to using the platform to invest with our people, with our tribe at Grid, and highly encourage everybody here that wants to do it. Get to GridCon, follow up with Stella, hit that QR code, figure out how you can use this to start building your empire. It's a
Yeah.
really good, I don't want to call it a hack because that kind of downgrades it. It is a strategy that I think you've really intelligently found and made really more viable and available to people. So it's a great
Thank you.
platform.
Thank you, Mark.
And the fact that you're
That,
sharing it speaks a lot about you because a lot of people would be like, she just found plutonium. Why is she sharing this?
That's why I'm in the community. I believe in the power of many. That's why we're here.
Man,
okay, guys. Well, thank you so much for joining us, Stella. And we appreciate everybody that jumped on here. See you at GridCon. You guys can ask Stella more questions in person because she will be here next month. And looking forward to seeing you all. Take care.